Okay, everybody, we can start the last class for this international political economy class for this spring semester. Okay, today we will talk about financial crisis and especially we emphasize the most important global financial crisis after 2008. So in 1990s, there are numerous currency crises in Mexico, Turkey, and Britain. So what these crisis means in international political economy is in the 1990s, for example, since most of these economies opened their borders to foreign investment and international financial flows, a lot of times the speculative capital and most of the speculators across the international markets, when they see there is some kind of a weakness in terms of economic indicators or in terms of foreign debt payments or somewhat related to the value of a national currency. For example, they started to attack those currencies and they can also increase the volatility in domestic and international markets in for those kind of currencies. For example, in the 1994 Mexico, because it has higher inflation and significant foreign and domestic debt problems, and also there was significant political turmoil in Mexico. For example, Zapatista uprising started in January 1994, so Mexico was in some kind of a political and economic turmoil just in 1994. And this currency crisis, especially when the foreign investors who actually came to Mexico from outside or from abroad before 1994, when they started to sell their local currencies and try to return to the US dollar and repatriate those US dollars to outside world, most of the time these central banks and these domestic economies, because they didn't have the enough currency to absorb, or you can say to pay all those kind of foreign currency demands, it created sudden shocks and currency crisis. And these sudden shocks generally consequential, they actually caused numerous currency crises and significant devaluations. For example, in Turkey, one of the examples is 5th of April in 1994, for example, overnight, Turkey also suffered from the same crisis, like higher inflation, domestic debt, increasing interest rates, and lack of foreign currency to pay foreign debt, and political instability and social instabilities, all of these kind of problems, when they accrue or accumulated for the economy, when the foreign investors in this international financial system, when they saw the openings or when they see these kind of problems, they can go to the doors and try to repatriate their foreign investments into their own countries or to abroad, to other markets. So this also, like Mexican example, it also created a lot of problems for Turkish economy in 1994. For example, inflation doubled up, the living standards decreased, the government has to go to IMF and international financial institutions, for example, to have a standby program and try to reschedule its foreign and domestic debts. There will be significant unemployment and cuts in social spending, and governments tended to allocate less money to social welfare of their people under the conditions of these currency crises. So you can say these currency crises somewhat repeated the 1980s structural adjustment policies of the IMF and World Bank. So you can say they actually, again, created austerity policies. 1998 Russian and 1997 Asian crisis also happened to have this, especially Russian crisis was problem of foreign debt, and Russian economy in 1998, after the collapse of the Soviet Union, it was already some kind of an institution or destroyed in that decade. And you can say in 1998 Russia declared it couldn't reservice its foreign debt, so it's kind of a moratorium. So with significant domestic political problems, that Russian debt moratorium in 1998, for example, created significant devaluation in Russian ruble because all those foreign investors in 1998, for example, when they saw this moratorium declaration from Russian government, they also tended to go and exit the Russian financial circles or financial markets. In Asian crisis, for example, it was started against the Thai baht and Thailand's economy. The international financial system, for example, they started to attack in a speculative way to the Thai baht in 1997, and they saw that Thai central bank didn't have enough reserves to defend the value of its currency. So, for example, those speculative currency attacks spread to all over Southeast Asian countries and outside China and Japan. For example, these countries were taken or perceived as some kind of vulnerable to these kind of speculative and sudden foreign currency attacks. Most of these financial speculators, for example, they bet on the argument that these central banks in Southeast Asia couldn't defend the currency value of their domestic money. And it turned out to be, for example, most of these foreign investments from Asian markets, they also significantly exit from these financial circles. And like Russia, Asian countries, Taiwan, Thailand, and Indonesia, most of these governments also ended up at the door of the International Monetary Fund and get into standby agreements. They faced with significant devaluations. For example, one of the most enduring dictatorships in Indonesia, the Suharto regime, actually collapsed after 1998 as a result of this Asian currency crisis. For example, most of the time, the drops in living standards and the drastic cutting and drastic austerity policies that these governments implement just after this currency crisis mostly caused extra political turmoil and increased or aggravated the political problems of those governing parties in all these areas. In 2000, what they called the dot-com bubble in the United States markets, for example, it was about the internet companies and these tech internet companies after year 2000 and the Nasdaq market technology index of the American financial market. For example, those Nasdaq indexed companies, especially some of these newly founded and newly public offered internet and technology companies, they surged enormous levels. For example, Nasdaq reached almost 5,000 index just in year 2000. But when you look at the profit levels and the real valuations of these internet and technological companies, you saw that there was an enormous bubble, and it burst out in the year 2000, and most of these technology companies and internet public offerings, actually you can say, deflated in terms of value after 2000 crisis. So you can say in international financial markets, these kind of surges, according to the speculative tendencies or pulses of the financial markets, can occur at any time, because a lot of times during the speculative frenzy or during the market upswing times, a lot of people think these markets or these financial valuations increase further. And they, for example, put much more money or invest more in these financial markets as a result of these expectations. But a lot of times when somebody, or at a dairy result at a certain point, when a lot of people or majority of the actors in the market, when they decide that, for example, these valuations, these financial valuations became some kind of a bubble, those bubbles generally get burst when these people start to sell, because they think the valuations of these financial markets and these companies do not reflect the reality or real values of these companies. So, for example, a lot of people also lost money during that collapse of the Nasdaq in year 2000. And, for example, American Federal Reserve, with the effect of the 2001 terrorist attacks in international relations, you can say Federal Reserve up to 2007, for example, pumped up a lot of US currency or US dollars to the international and American financial markets and lower down the interest rates, because of try to smooth out the American Central Bank or Federal Reserve, try to smooth out the effects of this 2000 Nasdaq collapse in American financial markets. Because a lot of times, even though in liberal theory, as we discussed in this class before, even though liberals generally think that the markets without any government intervention can correct their excesses and can correct the faults within those markets, the market actors, for example, according to the market supply and demand, they can adjust their positions. But in reality, for example, especially in these kind of speculative environments in international financial system, this is not that simple. And without government interventions or government regulations, a lot of times this financial circles and financial markets are very prone to crisis and very prone to emergence of these kind of bubbles. For example, as we will see, the 2008 financial crisis that was, for example, as a result of the collapse of the subprime mortgage market in the United States and the bubble of the real estate markets in the United States that caused the primary issues in this 2008 financial crisis and ensuing Great Recession across the international markets. So if we come to the point, what happened during the 2008 financial crisis? Initially, it burst out from the subprime mortgage crisis in the United States. So where this subprime mortgage crisis comes from? Banks generally lend loans to unqualified people. These people generally are in a very dubious situation that they can, or there is increasing doubts, for example, whether these people can easily repay these mortgages when they buy a house. But why the banks generally lend these loans and somewhat lure these people to the low interest rates and these subprime mortgages? Because banks sliced up these mortgage credits into collateral debt obligations. These CDOs, they are generally a mixture of different debt payment promises, either commercial or can be, like in this case, the subprime mortgages or other mortgages, car payments, student loans, all these kind of loans in the financial system. They're packaged in these collateral debt obligations and what they call CDOs. And these CDOs sold in the secondary market in financial system, what they call derivative markets. These derivatives generally what they mean is these derivatives do not contain any value themselves. They are just paper assets and some kind of a new financial instruments in the international financial system, especially their total value and total transactions reached almost $6 trillion just before the collapse of this mortgage market in the United States. So derivatives generally reflect the value of this underlying assets in these collateral debt obligations and credit debt obligations. So in CDOs, generally there were mixtures of these different loan payments, and there are some kind of a promises about the future. And as long as these debt payments are done and these people generally comply with these payments and in their time, you can say these derivatives generally reflect some kind of a value in the secondary market. But the main profit of this banking sector is they sell these derivatives in the secondary market, and they got profits not only from selling and buying these derivatives in secondary market operations, but they also got fees just issuing these credit collateral debt obligations in secondary markets. The credit rating agencies, for example, in the United States and outside world in international financial markets, actually assessed and gave good ratings. These CDOs. So, for example, in the international financial markets, the attraction of these collateral debt obligations and their transactions facilitated by these good credit ratings that they got when they issue these collateral debt obligations from these credit rating agencies. So they are also, as an important international financial actors, they are also part of this international actors responsible for this emerging of real estate bubbles and derivative bubbles in the international financial system just before 2007. Banks also of these CDOs in shadow portfolios. Not in their balance sheets, but they created structural investment vehicles and their balance sheets, what they call shadow portfolios of these banks. So a lot of times, most of the time, you can say for the financial transactions of these derivatives, most people are under dark. Nobody knows how much amount of CDOs were, for example, in the portfolio of these international financial banks or banking institutions, investment banks and commercial banks, all of them got into this business, from Deutsche Bank in Germany, Royal Bank of Scotland in England, BNP Paribas in France, or Chase Manhattan or JP Morgan Chase and Citibank in the United States. So these giant banks all included in their shadow portfolio all these credit collateral debt obligations. But the issue is when you spread the risk in these kind of collateral debt obligations, actually you don't decrease the risks of risk in case of a default of the payment, but you actually spread the risk and created some kind of a contagious factor in international financial markets when you actually spread the risk through the distribution of all these loans in different collateral debt obligations. So system was very risky just before the 2007. And after 2006, when US real estate market started to lose value, that was the beginning of this collapse of real estate bubble and subprime mortgage. And as a result, all these derivative businesses in the international financial markets. Why it started from the real estate markets in the United States? Because most of these derivatives included what they called the subprime mortgage credits that were given to unqualified people across the United States. And these are generally vulnerable, poorer sections of the population when they couldn't, for example, pay their mortgages after the real estate market started to lose value and when the economy started to sign or starts the signs of recession or economic growth actually somewhat decrease after 2006, those defaults or bankruptcies in subprime mortgage markets directly affect these derivatives in the secondary markets, because most of the time in secondary markets, these derivatives reflects the value of these subprime mortgages and those collateral debt obligations. But if the primary payments, if they weren't done by these debtors, more than likely in the secondary market, these investors started to panic about these derivatives, because there is no income stream to these derivatives because of these underlying assets are collapsing. So that panic spreads derivative markets after 2006, and year 2007 and 2008 were actually get into this economic turmoil, and the United States economy started to decrease in terms of growth numbers. So this economic slowdown, the incoming elections in the United States, and this collapse of the subprime mortgage market, when all of them combined, you can say as a consequence, these derivative markets get into some kind of a crisis. And for example, some important players in the market like BNP Paribas French bank stopped derivative transactions after 2007 because they saw these emerging problems regarding the collateral debt obligations, and they couldn't continue this kind of, for example, shadowy market in the international financial system because of this, you can say, unknown effects of all these collateral debt obligations and contagious effects of these risks. They try to stop these derivative transactions. And afterwards, for example, the American company Bear Stearns in 2007 and 2008 also declared bankruptcy, and it bailed out by the federal government in March 2008. So these kind of, for example, Royal Bank of Scotland in England or Britain, for example, nationalized by the British government, all of these were actually some kind of signs of upcoming crisis in the international financial system, because most of these governments tried to bail out these banks, since if they let them totally bankruptcy or totally declare defaults in their debt payments, more than likely these credit chains in the derivative markets can extend to all over the international financial market. But in September 2008, when Lehman Brothers American Investment Bank collapsed and it declares its bankruptcy and couldn't pay its debts in the international financial markets, that was a turning point when the United States government under Bush administration, for example, declared that they wouldn't bail out the Lehman Brothers, and they let them collapse and declared bankruptcy. That night in September 2008, for example, it starts a sudden stop and freeze up of the international financial markets. There is no credit taken or given by different banking institutions towards each other, and credit markets frozen up at the end of September, at the end of these events in September 2008. So because of that increasing risks, with more than $700 billion, Troubled Asset Relief Program was declared by the United States Treasury and Federal Reserve. They tried to bail out all these international investment banks, because otherwise, if there is no this kind of TARP program, or if they don't relieve those troubled assets in financial markets, more than likely the entire credit system will be frozen. So that will have, for example, a lot of bad signs or bad consequences or insurmountable consequences for the real economy. So in order to prevent that kind of a froze up of credit, they actually bail out all these investment banks other than Lehman Brothers after September 2008. And economic activity increasingly slowed down across the United States and international markets as a result of these bankruptcies. Credit tightened in the international economy, and developing countries and in developed capitalist markets, people saw the underlying values of all assets from stocks to the bonds, a lot of them shaken. And most of the, for example, money returned to the much more safe investments like gold and US Treasury bonds as a result of the 2000 financial crisis. And unemployment actually increased across the world. A lot of times, again, austerity policies became talked or started to be talked about in the especially developing world or emerging markets. So that 2008 financial crisis showed that without enough regulation and coordination, when you let all these financial markets to their own resources and to their own actors' decisions, there is some kind of an increasing risks of these kind of collapses and bankruptcies. So financial markets by themselves, these markets without any proper regulation and coordination, more than likely they could bankrupt or declare bankruptcy, and this credit system can frozen up and it can spread to other parts of other sectors of the economy. And it has also negative international implications under these global conditions. So because of this, most of the people after 2008 Great Recession, they saw that this neoliberal economic argument and this free market, free trade ideology of international financial system and international capitalism should be questioned, because these all consecutive crises, those respective crises from 1990s to the early part of the 21st century, we saw that these markets are increasingly prone to these financial bubbles, and they increasingly act independently from the real economy. But they have very dramatic consequences for the actors in real industries and real economies. For example, high-scale unemployment and lack of credit generally directly affects the real industry and real productive sectors, because of even though, for example, financial markets are secondary to the real economy and real industry in terms of their priority, or in economy's priority, today they became much more important because they generally connect this credit flow across the real production and real industry. So these sudden credit stops and credit crisis has directly negative consequences on the unemployment levels and the real production processes. And most people generally, they see their retirement assets, incomes, and living standards drop down or decrease as a result of these financial crises. So they have also very dramatic results and consequences for much of the people in the developing and developed world as a result of this 2008 recession. For example, in 2010, Greek economy, for example, declared bankruptcy as a result of this credit tightening and lack of foreign currency and lack of foreign investment in Greek economy. For example, even their situation in Eurozone was start increasingly questioned, since Greece as a government, Greece government declared that they couldn't repay its foreign debt under those conditions. So it was much more complex reasons. It has much more complex reasons, but it was one of the consequences of this 2008 financial crisis. So I think we finish this semester today. Thanks for listening.